Hello, so it's the time of the year again where it's essentially the big tech earnings season, and do look forward to more upcoming earnings breakdown, especially for companies that I do have a vested position in. And to kickstart this entire discussion, I'll be talking about Meta platforms in this specific video. More about their numbers, why the market is reacting so favorably, and as of the time of this recording, Meta is actually up 18% pre-market. So do remember to always smash that cute little like button before you forget. Now, I think just to square away some disclaimer in case you guys might have the wrong impression. Currently, I do have a Meta position. It's around 2.4% of my portfolio, and I do have a cost price of around 188. So in this video specifically, I'll just be focusing on the numbers and whatever that was released in the Word document and also the slides itself. I'll probably do a part 2 and released in probably tomorrow or something, diving deeper into the thesis and what my subsequent actions would be, whether I'm going to add, whether I'm trimming, whether I'm just keeping status quo, and more importantly, look into the valuations of what the market is essentially trying to price in. So for this video, we'll just try to make sense of the numbers that was just reported. Let's dive right into it. So our community continues to grow, and I'm pleased with the strong engagement across our apps. Facebook just reached a milestone of 2 billion daily actives. That's a phenomenal milestone. So the progress we are making on our AI discovery engine and Reels are major drivers of this. Beyond this, our management team for 2023 is the year of efficiency, and we are focused on becoming a stronger and more nimble organization. I think it's quite laughable. For the year of 2023, most big tech, or if not all companies, probably focusing on efficiency and optimization. But those are just fluff. Let's just look at the numbers because numbers don't lie. So if we were to look at it, top line revenue actually decreased 4% year on year. It's not really something mind-blowing because we are already expecting Meta platforms to continue slowing down. But I think in this case, costs and expenses balloon up by 22%, and income from operations was actually down 49%. And if we were to look at operating margins, it paints a very dangerous picture, from 37% all the way down to 20%, and that's essentially like a 50% cut in terms of margin. Definitely a red flag, and I'll go on to explain a little bit more about. As of now, it does look like it's one-off. It's not really a recurring theme, but we cannot deny that even if we add in that one-off charges, which will be explained later about this entire idea of restructuring, it's still on a clear downtrending line. Operating margins for Meta platforms is looking bad. Notwithstanding the fact that we are currently in a very slow environment, macro is bad, and even looking at revenue, Q4 of every single year is supposed to be the banger year. So I'm not going to waste too much time in terms of the users. They continue to grow users, increasing 5%, 4%, 4%. Facebook or their family of apps, including WhatsApp, Instagram, it's not a dying platform. And that is very well, or that is clearly put out in my thesis. I don't think Facebook is a dying platform. But bears can continue holding on to the view that the cute little blue app is irrelevant. Personally, I don't think so. So in terms of ad impression, in the fourth quarter of 2022, ad impression delivered across our FOA increased by 23% year on year, and the average price per ad decreased by 22% year on year. And this is the concerning part because we know that there's a huge slowdown in the advertisement market. And as Amazon and Google take over the baton from Meta and continues to report out into the week, we can then try to cross-check and triangulate the data point to really try to understand what's the current pulse of the advertising market and whether is it really a macro condition, whether is it a advertising industry issue and challenge, or is it just targeted towards Meta platforms. But I think for Facebook's case, they really tried to offset this issue of revenue growth by just bumping up the impressions delivered. So it just feels like numbers are very manipulated. So prices were down 22% and they just increased the ad impressions by 23% to try to offset it. So there is no negative year-on-year increase. And that's just that. Now, costs and expenses also ballooned. So the total cost and expense were 25.7 billion and 87.6 billion, an increase of 22 and 23% year-on-year for the fourth quarter and the full year of 2022 respectively. So this includes charges related to our restructuring efforts of $4.2 billion and 4.61 billion in the fourth quarter and the full year of 2022. They do have a table for this in the later part of this document, so we'll talk more about that later. So in terms of share repurchases, we have repurchased 6.91 billion in the fourth quarter and 27.93 billion in the full year of 2022. So as of December 31st, which is the earnings quarter and last year, we had 10.8 7 billion available and authorized for repurchases, and they've announced today another increase of $40 billion in our share repurchase authorization. So what this means in layman terms is, if you add these two numbers, just a simple quick math, it's $50.87 billion for repurchases. And if you were to look at Meta Platforms' valuation or market cap, before this whole bump up in price, it was trading near $380 to $400 billion valuation. So just divide it, 50 billion divided by 400 odd billion, let's just give it 400 billion. That's 1/8 of the entire market cap. And you can't really blame the market for trying to push up Meta Platforms' valuation by 18-20%, because that's essentially what they're doing. They're trying to establish a floor on the share price. And I think in hindsight, of course, when you look at Meta Platforms trading at like what, $80-$90 then, it does look a little bit ridiculous. But this is, of course, hindsight bias. Now, their cash and cash equivalent on their balance sheet is around $40 billion. And looking at it, looking at how they just announced the 40 billion increase in share repurchases, I would presume that they're not going to touch their balance sheet, but instead deploy capital or deploy the free cash flow coming to the business in the year of 2023. But I might be wrong. We'll talk more about it when we go into the balance sheet category. So in terms of headcount, the headcount is currently still sitting at 86,000 people. That's a lot. I think that's only a small marginal decrease from the previous quarter, but they did say that our reported headcount includes a substantial majority of the approximately 11,000 employees impacted by the layoff. So essentially, in the next quarter, they will no longer be reflected, and we can probably see that the numbers will probably come down to a more manageable amount of around 75,000 in Q1 of 2023. Now, this is the restructuring table. I think this is pretty concerning as a shareholder. I'll explain why. So looking at this, the total restructuring charges recorded under our family of apps segment was around $3.76 billion, and the RL, which is the Reality Labs segment, were around $440 million. So you can see that there are three main categories: facilities consolidation, severance packages, and data center assets. So in terms of this 1 billion or 975 million, I have not much question. But in terms of this write-down for this restructuring charges of the remaining around $3+ billion, so from an accounting perspective, this write-down of $3 billion is just poof, it's gone, because the company or the management team deems that it's not effective to recognize these so-called assets, so they just charge it under the expenses column, which also explains why the cost actually ballooned by such a large extent. So they did say that their operating margin would have been 13 percentage points higher. So if you add back this 13%, operating margins would be sitting at a measly 33%. And like I said, the downtrend is still intact. Downtrend in terms of operating margins, 37% in 2021, down to around 20 plus 13, which is 33%. And if you really plot it out, if I'm not wrong, operating margins for Facebook in the late 2010s, which is 2018, 2019 era, it's probably easily above 40%. So you can see that it's still downtrending. And I think your job as an investor is to really determine whether is there a flaw in terms of this operating margins. And when you make your projections forward, how do you expect things like Reels monetization? How do you expect things like Reality Labs, and how strong their family of apps is going to bring back this operating margins for the entire business? But that's just some consideration. Now, some of the CFO outlook, and I did color code it so you can see that the green parts are the good parts. So they actually expect the first quarter of 2023's total revenue to be around the range of 26 to 28.5 billion. And why is this good? Because if you do look back in terms of the revenue estimates by analysts, actually for Q1 of 2023, they actually estimated around 27.25 billion. And now, 27.25 billion is around the middle range of the estimates of what the CFO is guiding. And this definitely gives investors some sort of confidence as well, because if they were to guide the upper bound to be 27 billion, that will probably send the stock down again, because that's extreme weakness. So the CFO also anticipates that the full year 2023 total expenses will be in the range of 89 to 95 billion dollars, lowered from their prior outlook of 94 to 100 billion. So do understand that the market is always forward looking. So based on their previous outlook, they already guided 94 to 100 billion. So that's essentially quote unquote priced into the stock. And by this lowering in terms of guidance, it's definitely good, because any incremental or additional $1 billion it's going to be accretive to shareholders, because it will flow into earnings and stuff like that. But do note that they are still expected to record an estimated $1 billion in terms of restructuring charges in 2023, which is on top of these figures. So as of now, they recorded around $4 billion. That's another billion in 2023. So they also expect capex to be in the range of 30 to 33 billion, lowered from the prior estimates of 34 to 37 billion. So you can probably kind of understand why the market, or essentially why the stock price is reacting so favorably. Firstly, top line growth of active users, it's still growing 4 to 5%, despite everybody saying that it's a dying app. They did announce a huge amount of share buyback program, up to $50 billion that is authorized. And not only that, in terms of their revenue guidance in Q1, it's actually fairly decent. I wouldn't say it's too good or bad. And more importantly, in terms of capex and in terms of expenses for 2023, they all guided lower, which is why investors are getting excited again. But I do like to caution everyone, because looking at the balance sheet, it does scream certain red flags, or at least yellow flags for now. So generally speaking, just looking at the major categories of costs and expenses, marketing and sales and general admin stayed relatively flat, but I think R&D continued to balloon. And I think this is a recurring theme for Meta, at least in the near future. And by near future, I mean at least the next 1 to 3 years. And shareholders have to be comfortable with that. If you're not comfortable riding the wave with Meta platforms or with Mark Zuckerberg in terms of how they're going to allocate capital in their upcoming R&D efforts, whether it's in Reality Labs or whether it's in the family of apps, then I think you should actually avoid the stock totally and avoid the company. Moving on, I think looking at their current balance sheet position, do note that in 2021, or at least compared to 2021, in 2022, they actually took on a debt of around $10 billion. There was certain costs involved, but I think they issued some bonds. And I'm not too sure what the interest rates are, but if I'm not wrong, it's still on the lower rung, probably between 3 to 5%. But correct me if I'm wrong, I stand corrected on that. And if you look at in terms of their current assets, I'm just interested in the two top line figures, because those are liquid assets. From 2021, if you just do a very vanilla comparison, they had 47 billion liquid cash on the balance sheet, and now it actually came down to 40 billion. And some of you might be concerned about, hey, how are they going to fund the share buyback program of additional 40 billion? So they did commit, or at least the current authorization is around $50 billion. So the most obvious way is to use the cash on the balance sheet to essentially wipe out shares or eat up shares from the open market. But I think that's fairly dangerous, because we are charting into uncharted territories. And if there is really now there's still a debate between a soft landing versus a hard landing. So I'll presume that many companies would like to be on the safer end of the stick. And I think it's better if companies retain some sort of cash buffer on their balance sheet to kind of tide through any sort of storm. And I would presume that most of the buybacks for next year would be from free cash flow, which will be discussed in the later part of this video when we talk about the earnings slide deck itself. Now, so the next part is the most concerning part to me in this entire earnings call itself. So I know when we look at big tech companies, we always think of them as, oh, they are juggernauts. They are probably in a monopoly, if not an oligopoly. And in the advertising space, it's an oligopoly between Amazon, Google, and Facebook or Meta platforms. And we know that most of them have a boatload of cash on their balance sheet, and they have one of the most pristine balance sheet out there. But that said, I think one silent killer for many investors is really this idea of share-based compensation. And you can see that it's reflected quite transparently in the statement of cash flows. And if you to compare just based on a yearly basis, 2021 compared to 2022, 9.1 billion to 11 billion or $12 billion in this case. And that's harming shareholders, because the top line figures look nice. Oh, Meta platforms just authorized 40 billion, or they're going to buy back 50 billion. But if they're going to issue out every year another $10 billion, then if you net everything off, it doesn't look as pretty. So if you really think about it, even if the net income is high, and then once they adjust finish, because share-based compensation is not really a cash expense, looking at the free cash flow, yes, Meta platforms is still printing a pretty healthy level of cash from their main business. It's 14.5 billion. This is before excluding capex, of course. But 14 billion, if you to minus away $3 billion, any subsequent incremental buybacks are not as effective, because on one hand, they're trying to buy back, and on the other hand, the silent killer, they're just printing out to give employees. And if you to compare Q4 from 2021 to 2022, it's actually on an uptrend. So that's just some contextualization for many of these big tech share buybacks. So looking at this in Q4, they did say how much they bought back. Let me scroll back up. They did say that in terms of the share repurchase, they bought back around $6.91 billion. But because you need to net out this portion of the share buyback. So 6.91, you minus away 3 billion. Actually, they only bought back 3.91 billion. So it's not as big as the headline numbers. So just keep that at the back of your mind and do your projections accordingly. Now, pivoting over to the presentation deck itself, you can see that there are some signs of trouble. Essentially, other than the rest of the world that saw a year-on-year increase, every single major regions are down. So APAC 6.1 to 5.9, for Europe 8.1 to 6.9, and for US and Canada, they kind of held still. So it does seem like Europe is currently undergoing some sort of pressure, and advertisers are not spending as much money, and yeah, stuff like that. And I think one really important thing that people tend to write off is, oh, I'm buying meta platforms because of the family of apps. I don't really care about Reality Labs. I don't really care about their AR, VR, metaverse, whatever nonsense that they have on the sidelines. Of course, as a shareholder, it feels some sort like a call option. If it works, it works. If it doesn't, it doesn't. But if you really look at how they're spending money and how Mark Zuckerberg is allocating capital, from Q4 of last year, the RL operating losses ballooned from 3.3 billion to 4.2 billion. And despite spending so much money in R&D and stuff like that, revenue actually went down from 877 million to 727 million. So clearly the demand is not there. Clearly, the market is telling Mark Zuckerberg to wake up and to make something better. And I would like to believe that the S-curve or the adoption rate for many of these AR, VR goggles and whatever Mark is doing in the metaverse space is not really picking up. And if you triangulate data with other companies, I think even for Sony that are trying to explore into this space, it's not really picking up steam. Now, moving into the core metrics where all these social media platforms tend to use, they like to look at daily active users, daily active people, and stuff like that. Meta did manage to pull off something great at a 2+ billion, reaching 3 billion users platform. They still continue to grow around 4 to 5%, and their engagement rates still remains relatively high. But I think the issue that was also voiced out or at least a concern that was voiced out in the earnings call was that Mark Zuckerberg did say there is still a huge hurdle to kind of cross in terms of monetizing their reuse platform. So it will probably remain as a headwind in the upcoming 12 to 18 months. So just keep that at the back of your mind. And I probably would not expect operating margins or margins in general to just inflate back up, because they're essentially cannibalizing many of their current old kind of feed and stories and stuff like that, because those are much more easier to monetize compared to reels and short form video. And last but not least, I think I just wanted to focus on this key metric, which is Meta's position to generate free cash flow. Essentially, I think previously, back in 2020 and 2021, we can safely say that Meta was able to spit out around 40 billion in terms of free cash flow per year. And I think for the first two quarters, at least for the first quarter, it's still fine. But in the second quarter, we did see that there was essentially a 50% year-on-year decrease. And in Q3, it was the most abysmal performance to date for Meta platforms. Free cash flow was essentially incinerated. It went to near zero. But at least in Q4, they did manage to prove to investors that, hey, they're able to spit out free cash flow again. But that said, if you were to do a year-on-year comparison, it still looks pretty discouraging, because from an 18.1 billion to a 14.5 billion, and capex is definitely still on the rise because of many of the reinvestments into the family of apps and Reality Labs. So I'd just like to say that Meta is really in a very interesting place right now. Valuations are definitely compelling, but after this run up, of course, I think it's trading at a forward price to earnings of more than 20 now. Initially, in hindsight again, if it was trading at 90, it was probably a pretty interesting buy. But that said, there are a lot of moving parts in the business now, and you as the investor have to make the value judgment on whether you want to back your capital behind Meta platforms, despite all the issues that they're facing right now, whether is it from TikTok, whether is it from competition in the advertising industry, slowing macroeconomic condition and stuff like that. I'll spend a little bit more time in terms of dissecting my thesis around Meta platforms and what I intend to do in part 2 of this video. So do stay tuned. With that, I'll see you in the next video, but more importantly, I will finally see you on the moon. Goodbye!